So my opinion on interest rates is the economy is currently not in the strongest position. As from the jobs report we just got recently, over 80,000 jobs have been lost in Canada, mostly full-time. It doesn't look promising from that perspective.
What I'm seeing right now is that the interest rates are very volatile. They had gone down significantly in the past couple of months. Interest rates are very reactional. Nobody can predict what's going to happen. The reality is that interest rates are only predictable in a very short period of time. What does that mean for you as an average Canadian? If the rates went up from, I don't know, 3.79 to 3.89 or 3.99, which is very little, you're not going to have a huge difference. If you're specifically focused on renewing your mortgage, if you had a mortgage 5 years ago at 1 to 2%, which was the interest rates 5 years ago, and you're renewing now and the interest rates are 3.5 to 4%, and you're worried about your payments, that is a different situation. You need to sit down with your mortgage broker. You need to talk to them about the finances and see how are you going to be able to afford your home, because there are things you could do.
Hi, I'm Milan Gonda. I'm a realtor, general contractor, and real estate investor. Today I'm with my lovely wife and mortgage broker, Helen Gonda.
Hi, thanks for having me.
So today we're going to talk about the market and what's going on with interest rates, supply, demand, how things are going. What I want to start off with is what everybody usually cares about when they talk to a mortgage broker or a realtor and stuff like that, is interest rates. So my opinion on interest rates is the economy is currently not in the strongest position. As from the jobs report we just got recently, over 80,000 jobs have been lost in Canada, mostly full-time. It doesn't look promising from that perspective. There's a lot of pressure in the real estate market in Ontario and Vancouver and Calgary to a lesser extent, but Ontario is taking the real brunt of it. So there's a lot of recessionary feels across the country. Nova Scotia has been relatively unscathed in that regard. The real estate market's been relatively strong. They haven't seen any really cracks in unemployment. But we are seeing more supply, and especially on the condo side. Now, there is the global factor of oil everyone's talking about right now with Iran. Oil will bring inflation. That inflation will be temporary. When oil goes back down, and it will go back down, and we still don't have those jobs, and inflation goes away, you can expect cuts. That seems inevitable at this point. Unless the magic recovery in Ontario or Vancouver and all of a sudden or the population increases and we have another COVID 2.0 where people just start buying houses left and right and we start importing immigrating lots of people, things aren't going to change. The trend is there. I've seen this game before. I've seen it in Edmonton a decade ago. Prices are going to come down, especially on the condo side. Now, we've had a generation of landlords that if you tell them, what would you do if your rental rates decreased by $300 a month? Has not been a concept that just been familiar with, because they've always gone up. Like historically, for the last 20, 30 years, there's never been a decline in rental rates, or at least not significantly in a broad form. I would like to ask you, as a mortgage broker, as more of the professional, where do you see interest rates going?
If I had a crystal ball, I would be rich. But from a professional standpoint, from what I think is going to happen, what I'm seeing right now is that the interest rates are very volatile. They had gone down significantly in the past couple of months. They just went up yesterday and the day before with the reaction to the oil. Interest rates are very reactional. They're not, as much as people like to think that interest rates are being predicted within the next 6 months to a year to 3 years to 5 years, where banks somehow have some kind of magical calculation on what is going to happen. That is not true. We have been working with economists. Banks have their own economists. They have their own people that they work with that they pay a lot of money to project interest rates. And unfortunately, we react our interest rates react to what's happening in the world, globally and locally in Canada as well. Nobody can predict what's going to happen. Some people are saying there's going to be another big war. Some people are saying, the rates are going to go up again because they're so low. The reality is that interest rates are only predictable in a very short period of time. So as Milan is saying, with the job loss, the interest rates went up because of the reflection to the oil price increase. However, now that we have new data stating that we have a significant job loss in Canada, the rates should be going back down. So again, you're going to see this slight up and down. And what does that mean for you as an average Canadian? If the rates went up from, 3.79 to 3.89 or 3.99, which is very little, you're not going to have a huge difference. If you're specifically focused on renewing your mortgage, if you had a mortgage 5 years ago at 1 to 2%, which was the interest rates 5 years ago, and you're renewing now and the interest rates are 3.5 to 4%, and you're worried about your payments, that is a different situation. You need to sit down with your mortgage broker. You need to talk to them about the finances and see how are you going to be able to afford your home, because there are things you could do. You can increase your amortization. It's not the end of the world, right? You increasing your amortization, people are scared of that because they think, oh my God, I'm never going to pay off my house. Well, that's not true. You can do lump sums. You can do something. It's better to have a longer amortization than miss mortgage payments and go into default on your home and not be able to afford to live the way that you want to live or the way that you do live. Most people have a ton of other debt. So when we look at their renewal, we're seeing that they have a lot of other things. They have expensive vehicle loans, they have student loans, credit cards, lines of credit. All those tend to be at higher interest rates than a mortgage. And so we sometimes consolidate that into the mortgage to give them less payments per month, because if you have, 5 different payments coming out every month, it seems overwhelming. Versus just having your mortgage at a lower interest rate. So when we look at clients' renewals and I'm talking to somebody and they're very interest rate sensitive, there's something else going on there. It's not about the interest rates, it's something else. And it's my job to get to the bottom of what exactly is, what is going on. Most of the time it's affordability. Interest rates equals affordability, fear of affordability. If you're a home buyer and the interest rates are high, of course, you're pre-approved for less because the mortgage payments are higher. However, if the interest rates drop very significantly, or if the interest rates are very low, from COVID, from seeing this in the last couple of years, that the housing market and the house prices skyrocket because now everybody can afford a house and everybody's fighting and outbidding each other and driving the real estate market up. So as Milan said, it is supply and demand, but at the end of the day, I kind of like to look at it from a different perspective. When people are so worried about interest rates, it's usually not about the interest rates itself, it's something else. And once I get to the bottom of what it actually is worrying them, what exactly is the issue, we can work that out. Because realistically, if you don't really have a choice. If you're renewing your mortgage, the interest rate is whatever it is at the time of renewal, and trying to scrape for a 10 basis point discount between different banks, it's not going to save you a ton of money overall, unless your mortgage is millions of dollars. It would help you to actually sit down with somebody who's a mortgage professional and talk to them about your finances and see what is the fear behind that interest rate increase and your fear behind, being so sensitive to rates. Because again, it's not, in my opinion, it's never really about the interest rate. Nobody cares about interest rates. They care about something else deep down.
So I want to shift things over to the demand side of, are we in a buyer's market, seller's market, neutral market? When I get asked that question, I just say yes. real estate is always local. I mean, just because we're in a seller's market and one type of property, we might be a buyer's market in a different type of house in a different type of area. I mean, Canada is very broad, but you can even break that down by subsection and city by city and street by street in some cases in Halifax. So, where are we in a seller's market? Well, from the stats, we're currently seeing that the average price is still climbing up. And I'm more seeing that as the bottom bar rung is getting pushed up. The demand for properties under 600,000 is still high. It is still a seller's market. If you have a bungalow under 600,000 in Halifax, Dartmouth, close downtown, good access, you are in high demand. And you're getting multiple bidders in those type of properties, which is pushing the bottom rung up. Now you go to the opposite side and go to the entry luxury level of 1.1, 1.2 million that isn't waterfront. There is a lot of supply and demand has really fallen off since COVID. So there you're looking at a buyer's market. That's where you should be doing those more aggressive offers. Now, and we have everything in between. Now, this varies from region to region. This isn't just, you can't say the same thing for Halifax as Dartmouth or Fall River or Tantallon or Lawrencetown. It is very spotty. And even when you get down to Halifax and Bedford and certain areas are much more desirable than others. So you can see properties be stagnant and just down the road, 5 minutes, be super high demand, multiple bidding war situation. So we are in a very mixed market. There is no broad thing that you can say about the whole market. I'm not sure if that's what you're seeing as from the broker side.
From my perspective, it's very much the same, and I'll explain the reason for that from the financial side. It's because of the average household income. If you're looking at the average household income in Nova Scotia, I don't know exactly what the number is, but I would say like an average person makes between like 60 to 70K a year. And then like, let's say they have a spouse, their average household income is around 120,000, which seems like a lot of money. And this is gross income. This is not net. If your average household income is between $120,000 and $150,000 a year, if you are not a realtor and you're not a mortgage broker, you would think, okay, we have a ton of household income. Our monthly rent is $3,000 a month, not including utilities. I could definitely afford a house. No, that is not true. Unfortunately, the calculations for home affordability are very strict with most banks and lenders. And so people who come to me who think because they've never missed a payment on their rent, because they've never missed any payments on their other debts, and they have a good household income, that they're automatically going to be able to afford a really nice property. But the reality is if you have zero debt whatsoever, and your household income is 150,000 between you and your spouse, which is fairly high. Most people, it's around 120,000. Let's say it's 150,000 for the sake of numbers. What do you think is the average price that you can afford?
Going to be around 625,000.
How did you come up with that?
Pretty much times 4, plus a little bit, plus down payment.
The rule of thumb is if you have zero debt, your affordability is your household income times 4, right? So that puts you into pretty much everybody's category of the max of what you can afford. Anything under 650, it's still going over asking in HRM, because that's pretty much everybody who can afford a house. And that's the best case scenario. Most people who have, let's say, $150,000 household income, they also have other debt. Most people have 2 car loans, like you and I have a car loan each, some credit card debt, I don't know, some student loans maybe. And then that just brings down your affordability significantly because those are monthly payments. We do look at the debt overall, but what we really focus on the mortgage broker side and the banking side is what is your monthly gross income minus your monthly gross debt, right? So if your car payment's $600 and my car payment's $600, that's $1,200 right there that we're paying for cars. So that takes away significantly from your affordability. If you have I don't know, 10 grand on a credit card or a line of credit, that is a lot of money that you're paying for in interest alone. It doesn't matter if you're making interest payments only. We have to calculate unsecured line of credit and credit card loans at 3% repayment of whatever the total loan amount is. That's the rule of thumb for the banks and how we calculate your debt for credit cards. You could be paying $10 a month. That doesn't mean that's what we're calculating. We have to actually calculate you as if you're repaying it. Right? You might have a student loans that's not in repayment yet. Doesn't matter. We have to calculate student loans, even if they're not in repayment, at 1.5% of interest on the total loan amount. So now you have, I don't know, let's say $2,000 a month worth of payments outside of your mortgage. So of course your affordability is going to get dragged down. So all of a sudden you're going from $650 purchase price to maybe $500, depending on what their situation is for down payment. And how many houses have you seen in HRM for $500K? That's, I don't know, let's say you work in Halifax and I work in Dartmouth. We need something within the HRM vicinity so we can both travel. Yeah, how many houses are on the market right now under $500,000?
That aren't decrepit? Not too much.
Yeah, exactly.
And we're seeing that in the construction numbers, because if people can only afford $500,000, they want to have a house. Contractors can't build a house at profit for $500,000, which is why we have about 80% of new construction being condos, because that's what people can afford. It's not that 80% of people want to be in condos. The number is growing, but it is significantly less than that. It's more about affordability issue, and what developers can actually build condos for. There's a power of scale when you're building condos. It doesn't have the same kind of price inputs as you do for like a single family home, especially a single family home for lots that we can't really find. And if there is lots, they might be in areas where you need a septic and well, and that's another $60,000 addition just right there, just having that kind of issue. But we are seeing a lot of condos being built. And this inevitably will likely lead to an overbuilding. I mean, it happens with everything with supply and demand. I've never seen a shortage that was not followed by a glut.
Do you think that it's going to be a supply? Because we've had this discussion before, and I think this is where you and I kind of disagree, where you think that the supply and demand is going to change, but I think that the supply and demand for houses is still going to be where it's at, because we don't have a lot of new home developments in the city, and the ones that we do have are outrageously, astronomically priced at like $750, $850, $950. Who can afford that? I don't know. Somebody, but not most people. You see neighborhoods of houses for sale, but they're not the right fit for most people. No, like there's a very small percentage of people that can afford a $700,000 to $800,000 brand new house. And you and I like to call them cookie cutter because they're just the most basic house, like the most basic house you could find. So I think what's going to happen is people who have the older condos, the old condos that they bought that they thought are going to stay fantastic forever and that they're renting out right now, those people are in trouble. I think those people are going to have issues with renting out their condos, first of all, because the older the condo building, the higher the condo fees. Generally, that's the rule of thumb, because you have more maintenance or something happened in the last 20, 30 years of the condo that had to be repaired. And maybe you can talk about condo fees and what affects them, because a lot of people don't actually understand that. What makes up a condo fee? Why are they high in some places? Why are they low in others? I think that would be a good just topic for people. But I think that the condos and people who already own condos are in trouble for their future, and the ones that are being built are going to become the new starter homes or the new homes for retirees. But I still think that there's going to be a shortage on affordable houses, because a lot of the times most couples have little kids, they have families, they want a backyard, and most of the people I pre-approve don't want a condo, they want a house. And I'm not seeing anything for first-time home buyers in that affordability range.
Absolutely. The demand for single-family houses is still strong, and the supply is not increasing. So the pressure on single-family homes, especially at that 1,200 square foot and above level, the 3-bed, 2-bath, is strong, and we're not seeing any sort of significant supply coming online anytime soon. So when we got the CMHC stats that came back last week showing projections of Halifax property prices going up, basically closer and closer towards that 700,000 kind of range, despite the economic activity being relatively modest, it is that cause of supply and demand and for single family houses. For condos, however, that is a different story. You do not own the land, and it's the land that's getting more valuable. And condos, you can always build up, and we're seeing that. Halifax is densifying. We're building the skyline up, but we're also seeing a lot of problems with the older condos as well. And legally in Nova Scotia, there's supposed to be reserve fund studies on each condo. They're supposed to have their funds to repair themselves. As a general contractor, knowing what the costs are to repair stuff, you could see the gaps in the reserve fund studies because of...
For somebody who's not in the industry, because we're just having a conversation here, somebody who's not in the industry, what is a reserve fund? Because I know what a reserve fund is. You know what a reserve fund is. For an average viewer, what is a reserve fund? Like, nobody knows what that is.
A reserve fund from a condo standpoint is part of your fees are going towards fixing up your property and kind of planned obsolescence of certain things. Your roof, your windows, your decks, siding, all that kind of stuff needs to be accounted for and in your condo fees. You can't be running a deficit. You always have to have the funds. For the older condos, I'm seeing very low reserve funds, and the reserve fund studies are not giving me any confidence that they actually have the ability to do what they plan to do. They're kind of pre-COVID kind of estimates and totally not understanding like, oh, this condo has a pool. And they have like $10,000 allocated to fix the pool, when in reality, you're looking at $100,000 plus. And then you have to start looking at special assessments, which I believe when condos are going to have more and more issues when they go to do repairs, those estimates that they had in their previous reserve fund study are not going to be relevant in this post-COVID high cost labor environment. And you're going to start getting special assessments, which is the dread of everybody. Basically, it means the board decides everybody needs to pay a certain amount of money to fix an issue and stuff like that. I've had special assessments before. There's horror stories like out west when kind of you see that kind of collapse. I've had it personally, like $10,000 special assessment just kind of show up because the elevators weren't done properly and needed to get sorted out. The worst one I've heard of is in Calgary about a decade ago now, where super tall condo building, all the glass on the outside, and it was like an all glass tower, was not done properly. It was a risk hazard, might fall and kill people, stuff like that. It all had to be done. And it was about $70,000 per unit special assessment. I mean, that's devastating for everybody in that building. I mean, there's no way out of it. You can't, as soon as that special assessment comes out, there's no way to back out of it. You can't just like emergency sell your condo because everybody knows that's coming. I mean, your lawyer will assess that real quick of those kind of special assessments on a condo.
Yeah, no, that's pretty terrible. And like I had a work colleague who lived in a condo in Bedford, and they had a special assessment done on their outdoor heated pool, and everybody agreed that they had an option of, are we just going to bury the pool and just make a nice backyard, or are we going to keep the pool? So they had that special assessment, and they all agreed that they're going to keep the pool. So she ended up, I can't remember if she took out a home equity line of credit or refinance, but she had to borrow money from her home basically to pay that, because she didn't want to raise the condo fees. Because if you raise the condo fees, nobody's going to want to buy your condo, right? Like that happened to you.
No, absolutely. The condo becomes unsellable and your property drops. In a time of a decade, the property went from a value of about 270 to about 170,000. So,
but you don't even have a say in it, right? Because if you have 70 grand, but all of your other neighbors don't have 70 grand, they're going to vote to increase the condo fees, right?
The condo board is made up by the residents of the unit.
Yeah.
And it's not a good conversation. I've had it where pretty much people start yelling at each other because it's money, it's stressful. But it's ultimately the owners of the condo are the ones deciding yes or nay. Because if you need $10,000, the alternative is we need to increase your condo fees by $300 a month forever.
Good luck selling that.
Yeah, you'll never be able to sell that condo. So
Yeah.
it is, unfortunately, there's just less bad options. But banks understand that these kind of special assessments happen, and they can put them back on the mortgage and stuff like that. I know your kind of lenders kind of do that kind of stuff because usually those things come relatively quickly. Like, I need $10,000. Not everybody has that. Okay, we can borrow back from the mortgage, no penalties or anything like that for a special assessment because it's just going back into the property.
I haven't seen that.
Thankfully, not yet. I think the reckoning is coming for that kind of stuff once we actually start seeing fixing, and if it gets kind of cracked down on by the actual like health and safety kind of things.
Without getting sued, I could think of like at least 3 condo buildings in Halifax where like the condo fees are like $800 a month for 1 bedroom, and you're wondering what's included in that, and it's like snow removal. That's the ones that had those special assessments. I'm not gonna mention the names of the buildings, but you're like wondering why the condo fees are $800 on a 1 bedroom that doesn't include any utilities, right? Because some do include utilities, right? That's not terrible. You can count that in and say, well, the condo fees are like $500-$600, but everything's included.
Yeah,
that's not bad. Like, that would be nice.
No, absolutely.
You only have that one payment. You're not worried about paying all the utilities, especially in Halifax with the heating costs and the power. And I'm not gonna name names, but
No, absolutely. And it may sound strange for a realtor to tell you not to buy some real estate, and I'm not saying that, but you should be very cautious in looking at condos. Your realtor should be really looking at the paperwork and the reserve fund study and stuff like that. And if you're looking from an investor standpoint, how would you handle if all of a sudden your rental rates drop by $300 a month and it's vacant for several months out of the year? And as the market gets more and more competitive, as these thousands of units are coming online and competition comes in. I'm not saying don't buy a condo because it does make sense for certain people, especially people retiring and they're downsizing from their house. Their condos can make a lot of sense. But I'm just advising a lot of caution. We don't want to be in the situation where Toronto is, where people are losing hundreds of thousands. Now they're stuck in their condos.
Oh, that's a whole other conversation because the new condo buildings now, they're appraised, the units are appraised at below what they were appraised at before they were being built. So if your condo is $1 million when you originally accepted the building, and then the year later, which is now, is what's happening is the condos are worth $700,000-$800,000 instead of $1 million. The banks have to blanket that shortfall. It's not a great market to be in.
That's a long conversation about blanket appraisals and OFSV is finally cracked down on, like RBC just recently. I don't foresee that kind of trouble happening in Nova Scotia, but I'm not saying it's all fair seas currently for the condo market. I'm advising a lot of caution.
Yeah.